the stock market, during a downturn, everyone wants to know how long the downturn will last. Not because everyone wants to invest, but because the sentiment of every share is connected to the market sentiment. If the market is going down, it will have an impact on the shares in your portfolio. So, the big question is, where should one start investing in the recent downturn? If yes, can we start by investing in debt-free companies? Let's find out. Anshu, who lives in Moti Bagh in Delhi, has always paid more attention to fundamentals than technicals, and for her, knowing about promoters, debt and financial ratios is like routine hygiene before buying any shares. To gather information about some debt-free, sound fundamentals companies, Anshu called her cousin Pallavi, who is associated with a research firm in Gurugram. Pallavi informed Anshu that currently there are 73 companies in the Nifty 500 index that have no outstanding debt, meaning they are debt-free. Now, out of these 73 companies, 8 are from the IT sector. IT companies typically have a good amount of cash on hand, which allows them to reward their shareholders with share buybacks and significant dividends. As an example, on the evening of October 11, along with the results of the second quarter, India's largest IT company, which is Tata Consultancy Services (TCS), announced a buyback at a price of 4,150 rupees per share, totaling 17,000 crore rupees. This is the company's fifth buyback in the last 6 years. So, if we exclude these 8 companies from the list, we are left with 65 companies. According to Pallavi, there are 2 critical criteria to assess these 65 debt-free companies. What are those? Well, let's find out. These criteria will help determine which of them can be considered for inclusion in a portfolio. The first criterion is ROCE, which stands for Return on Capital Employed. ROCE provides an estimate of whether a company is effectively managing its capital for its business. The higher the ROCE, the better the financial position of the company. Looking at companies with ROCE above 30%, only 24 companies out of the 65 meet this criterion. However, for these companies to be considered, they should also have a good dividend payout ratio. The dividend payout ratio is the proportion of total profits that is distributed as dividends. It can be calculated using the formula DPS, which is dividend per share, divided by EPS, which is the earnings per share. Pallavi shortlisted companies from the 24 that also have a dividend payout ratio of more than 50%. This narrowed it down to 9 companies, which includes 3M India, Ritz Limited, GSK Pharma, HDFC AMC, CAMS, CRISIL, CDSL, Bata India and Vedant Fashions. Now, Anshu was quite confused among these 9 companies. To clear this confusion, market expert Ravi Singh suggests that Anshu can consider investing in the remaining 7 companies excluding HDFC AMC and Vedant Fashions. However, he particularly favors CDSL, Bata and Ritz. For these shares, Ravi recommends allocating 30% of the current amount, then an additional 30% if there is a 3 to 5% dip, and the remaining 40% if there is a 2 to 3% further drop. This strategy is expected to bring the average purchase price down by around 5% with an anticipated annual return of 12%, which would be around 17% based on the average price. So, in the declining market, Pallavi explained to Anshu how to begin building a long-term portfolio by investing in debt-free companies with sound financial ratios.